Last Friday, the price of silver has finally broken out above $30 per ounce. This is a very significant move because this line of resistance has held it back for almost 4 years. As a matter of fact, the last time that silver was traded above $30 was 11 years ago, in 2013. No wonder then that silver investors all across the world are celebrating this moment and keeping their fingers crossed that this is a sign of things to come. What is driving up the price of silver? What is it likely to do next? How will that affect the economy as a whole? Today we will answer all of these questions and more. As I've been saying again and again in the past few months, silver is a precious resource which is in short supply. Due to its unique physical properties, it is essential for industry. Of all the metals, silver is the best conductor of electricity and heat. It is also highly resistant to corrosion. Therefore, it is widely used in the electronics industry and in the production of solar panels. Thanks to the Green Revolution, this demand is only expected to grow. The supply, however, is far from guaranteed. For many years, the price of silver has been too low to warrant the exploration and development of new mines. As a result, since 2016, we've seen a continuous decline in mine supply, and in the past 3 years, we've had a physical deficit. These deficits gradually drain the above-ground inventories, to the point in which we are in danger of experiencing a shortage. But as we all know, silver is not just an industrial metal. For thousands of years, silver has also been used as money. Although it has been formally demonetized during the 1960s, people across the world still hold it as an investment. Together with gold, it is the only asset which is both useful and rare, and therefore tends to preserve its value. It is no one else's liability and can be owned directly, without the help of a broker or an ETF. In times of peace and prosperity, there is little demand for such an asset, and people would rather invest in stocks or bonds which have a yield. But in times of crisis, in which faith both in government and in financial institutions is waning, people need the security and stability which gold and silver represent, and the demand for them is rapidly growing. For silver, the combination of a falling supply, together with a rising industrial and monetary demand, is the perfect storm. In recent years, we have suffered the worst outbreak of inflation in living memory. Prices of basic goods, such as food and energy, have gone through the roof. Central banks have promised that they would fight this inflation by raising interest rates, and at first investors believed them and trusted that they can make this problem go away. But now they are discovering, to their great horror, that although inflation is still raging, central banks have already given up the fight. The Federal Reserve ended its tightening campaign in July of 2023, and in recent months has been signaling that it intends to cut rates during 2024. Since this is an election year in the US, there is little doubt that this is being done out of political reasons. The Federal Reserve is trying to boost the economy in order to help the re-election of Joe Biden and inflation be damned. Investors have no choice but to protect themselves, and in my opinion, this is what is leading them to gold and silver. Another factor which is affecting the price of precious metals is the emergence of the Shanghai Gold Exchange as a key player in this market. For many years, Chinese people used to invest their savings in real estate. This led to a huge flow of capital to this sector and encouraged the construction of an endless number of residential buildings. Many of these buildings ended up completely vacant, as there was much more supply of housing than demand. This bubble finally popped in 2021, together with the collapse of the China Evergrande Group, a major property developer. Simultaneously, the Chinese stock market hasn't been doing too well either, and has been moving sideways since 2016. This left Chinese investors with very few options, and apparently they are opting for precious metals. Unlike similar exchanges in the West, such as the COMEX or the LBMA, the Shanghai Gold Exchange operates a physical contract which does not allow margin trading or cash settlement. It demands that the full amount of funds and metals be deposited by the participants. This does not allow any price manipulations and ensures true price discovery. As a result, there is a constant spread in favor of the Shanghai Gold Exchange, which is putting pressure on the spot price of gold and silver to rise. Recently, this spread has increased dramatically, demonstrating how tight this market really is. Last but not least, we need to take into account the impact of central bank purchases. According to the World Gold Council, in the first quarter of 2024, central banks added to their reserves 290 metric tons of gold, the strongest start to a year on record. Among them, we can count the central banks of China, India, Turkey, and Kazakhstan. This trend is probably linked to the sanctions which the US has imposed on the Russian Federation after the invasion of Ukraine. The US has frozen Russian assets worth nearly $300 billion and recently decided to seize them and use them in order to fund the Ukrainian government. It has also banned Russian banks from participating in the SWIFT system, limiting their ability to conduct international trade. This has signaled other central banks, particularly in emerging markets, that in order to maintain their independence, they must acquire more gold. As the only reserve asset which is immune to international sanctions, gold gives central banks a high degree of security and flexibility. Since the prices of gold and silver are closely linked, this has no doubt contributed to the recent breakout in silver as well. When gold becomes too expensive for the average person, they go for silver, which is much more affordable. Unfortunately, the breakout in the price of gold and silver does not bode well for the US economy. Although it is not apparent from the stock market, which is again at an all-time high, the real economy is not doing very well. Inflation has eroded the purchasing power of most households, and whatever savings they have managed to accumulate during 2020 are already long gone. This means that the demand for goods and services is falling, even as their prices are rising. This is what we call stagflation, and it is what every central banker and every politician should fear most. Right now, economic indices are propped up by the deficit spending, but that is completely unsustainable. As the national debt is rising and the cost of servicing it is exploding, the federal government will have no choice but to cut back its spending or risk a currency collapse. In my view, this is exactly what the rising price of gold and silver is signaling. If you ask me, the move in the price of silver is just beginning. It still has plenty of room to run until it reaches its all-time high of $50 per ounce. And of course, there is no reason why it can't exceed this high and rise well above it. In my opinion, we are likely to see a rapid run to $50 an ounce, followed by a retracement and consolidation in the range of $30 to $50 an ounce. This phase may last between a few months and a year, during which many newcomers will lose faith and sell. It could also continue for longer, but I seriously doubt that. Once this consolidation is over, silver will be ready to once again charge the $50 threshold and advance to new all-time highs. This will probably be prompted by some sort of an event, which will prove that inflation is getting worse and that the central banks are helpless against it. So if you're just now hearing about silver for the first time, don't be discouraged. We're still very early in the game, and this is an excellent entry point. Just make sure to buy physical silver bullion from a reputable dealer which you can trust. Don't use leverage and don't go into debt in order to buy silver, because that will undermine your ability to withstand the volatility, which is sure to come. Stay away from futures contracts or ETFs, because there is no guarantee that they actually have the metal which they are selling you. As the saying goes, if you don't hold it, you don't own it. So let the games begin. I wish you all the best of luck. Thank you for listening to the Silver Hermit podcast. If you like this content, please donate in the link which appears in the description below. Please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, I'm not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.